Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Another earnings season is upon us, and our panel members weigh in on how it may impact the market, as well as some other stuff. Joining me today, Shiraz Mian, Research Director, ETF Strategist, Eric Dutram, and Senior Equity Strategist for Zacks.com, Kevin Cook.
And that's not just for the gray hair. Right?
Yeah, that's right. I didn't want to go there, but as long as you took us there. So, Shiraz, talk of economic recovery is great, but at some point it has to manifest itself on the corporate balance sheets. And you're looking at low expectations for this Q2 season.
We have actually seen those things on the balance sheets and income statements over the last many years. So we have come to the end of that cycle. The economy, both here and around the world, gave us good corporate earnings. In fact, corporate earnings in the absolute levels have never been this good. It's record earnings, record margins. The question is whether this rally into ever increasing earnings would continue into the future or comes to a stop. So expectations for Q2 earnings growth is very low, but expectations for the back half of 2013 and into 2014 are fairly aggressive by the way I see it.
All right, Friday's jobs report, was that a game changer for taper, Kevin?
You know, the way the market reacted to several things that happened on Friday made me walk away going, the market doesn't care about taper anymore. We got a headline good jobs number, right? We can debate about the internals, that it was more part-time work and less full-time, but still a good number overall. What does the bond market do? Yields raced higher. We're up 20, 25 basis points in a day, and the stock market barely flinched. What did banks do? You had the regional banks, the KRE index, up 2.8% to new highs. Russell 2000, record close above 1,000. All this tells me that the market doesn't care about taper anymore. We got evidence that taper is probably coming in September, and we go to new highs. And to Shiraz's point about earnings, from a top-down perspective, maybe things are starting to look a little toppy, and it's going to be hard to meet those expectations. But we've been talking about that for a year. The guys who pick stocks fundamentally bottom up, they're just looking at, their balance sheets, those companies that they follow, and saying, this is a 20, 30% grower. We've got to buy it here. That's what's lifting the Russell 2000. It's not just speculation. It's a lot of bottom-up stock pickers.
So, go ahead.
That's a very good point that Kevin raised. The rising tide lifting all boats kind of a scenario comes to an end. Stock picking, where you're looking at individual sectors, individual industries, and individual companies, that becomes the preferred skill in picking profitable stocks going forward.
So, Kevin, you think unless we see some real earnings bombs this Q2 season, correction is likely over?
Yes. Yeah. The market strength here is showing you that, there is still pent-up demand for equities. And so this correction phase that I thought would try one more time lower down to 1550, that's looking like it's off the table unless we get a big slew of pre-announcements or earnings bombs or some economic shock, and nothing. And those look like a low probability to me right now.
So, Eric,
Terry, one thing I'm a little concerned about is if you take out financials, we're actually seeing negative earnings growth for the quarter.
Yeah.
So I think this could really come into play, especially if financials don't live up to this billing that we've kind of given them, and that could be especially true if mortgage originations and other items kind of driven by these higher rates that we're talking about. Kind of cause some of these companies to kind of temper their expectations for the second half of the year.
So do you think the market is still in the bad news is good news groove?
No, kind of going along with what Kevin was saying, good news is good news once again, and we saw that with the jobs report. Granted, some of the items in there weren't too great. We saw a lot of part-time jobs being created, and a lot of the jobs that were created were in retail and lower wage sectors. So you could argue the quality of the jobs being created aren't that great. But beyond that, I think it was, we're back to good is good and bad is bad once again.
I think it's very heartening to see the stock market respond as it is, with an almost 60% jump in the level of interest rates over the last 8 to 9 weeks. But at some stage, you have to take a pause and see where does the market gets worried. If not 2.7%, is it 3%? Is it 3.5%? And where do these yields stop? So I'm happy that stocks are doing what they've been doing, but I'm very skeptical.
Yeah.
And on the earnings front, it's not so much the growth, it's not so much the surprises. I think those things would likely come as they have in Q1, perhaps 2% growth. Again, 2/3 of the companies beating expectations. It's going to be the top lines and it's going to be the guidance. Remember, top lines were extremely weak in Q1 in terms of
We're still
surprise.
squeezing more bottom line out of less top line.
Exactly, and then it's the guidance.
Yeah.
Because the expectations for the second half of the year in 2014 still remain quite high. We had about 2% growth in the first half. Expectation is for north of 9% growth in the second half, and 11.5% growth in 2014. I hope those expectations come through, but
Yeah, they're not being pulled back yet.
That's
so.
right.
So quickly, if there's one wild card out there for the market, what is it?
Interest rates spiking to 3%. So
Interest rates,
3%
exactly.
10-year yield. But, Shiraz has been all over this for 6 weeks, talking about the normalization of interest rates. We're coming from very low levels, artificially depressed yields, and look at how quickly the yield curve is steepening. The market does not seem afraid of that. So where does it impact? Does it? I didn't look at the 30-year mortgage, but is it pushing 4.5% yet? We push that up to 5%. Does that take a bite out?
Eric, you buying that?
I am, but I also think we still need to look internationally as well. We're seeing a lot of worries creeping up a number of emerging markets, be it Brazil, Turkey, Egypt, obviously, and then Europe. We keep seeing a couple small things creep out of there, be it Portugal or Greece trying to get more
Europe,
more
does it matter anymore?
But we could see a resurgence of that crisis too. But I'm with these guys. I'm looking for interest rates. I think that's going to be the big player.
All right, thank you all for that. There's an interesting theme in this week's Top Picks segment. Click on over to it and find out what it is.